Well, good morning, everyone, and thank you for joining us today from many places, Long Island, New York, and across the globe. Welcome to our discussion on global venture capital trends. We have a distinguished panel today representing important investment and technology centers throughout the world, including Israel, India, and the US. My name is Michael Lane, and I will guide today's conversation. I will first introduce myself and the panelists, give them an opportunity for opening remarks, and then talk about the investment practices of their firms and their regions. We'll start at a high level, drill down, and then take questions from the audience. Now, I am the chairman of the Long Island Capital Alliance. For over 35 years, LICA has assisted local companies in raising growth capital, comprised of entrepreneurs, investors, service providers, and business executives. Our community provides the support network necessary to build a strong Long Island economy. In addition to my other industry and board responsibilities, I am also the CEO of an emerging technology and smart locker company called Sterilux Systems. We have created a locker that uses the proven technology of UVC light to sterilize garments, shoes, and personal items. It is a smart device that interacts with our apps for data collection, user interaction, and compliance. We have started in the healthcare field, but have made inroads into other industries such as fitness centers, assisted living facilities, and the health and wellness industry. Now, I would also like to introduce, as we start, Lawrence Weber, who has been organizing entrepreneurship-focused events for CEWIT since 2013. Larry started his career with a PhD in physical chemistry and postdoctoral research at MIT, later morphing into international technology, business development, and startup and Fortune 1000 settings. His background is punctuated by product launches in the wireless, chemical process, electric power generation, and catalytic energy devices industries. Thank you, Larry, for putting together such an impressive panel. We really appreciate the work you've done here.
Thank you, Michael. It's great to be here with all of you.
And now we turn to the panel. I am joined today by Alexandra Choli, a founding partner at Metavallon, a venture capital fund, investing in early stage technology companies across Europe. She is a founder of both Impact and Mainstream Ventures and an active angel and institutional investor in Greece and internationally. Alexandra was among Fortune's 40 Under 40 in 2020 and was presented the Entrepreneur of the Year award by the British Council. She holds a master's degree in mechanical engineering from University College London and a Master of Business Administration from the NYU Stern School of Business. We are also excited to welcome Neil Cohen, the founder and chairman of Emerald Development Managers, a venture capital firm founded in 1994. He is also co-founder and co-CEO of American Rock Salt Company, the largest salt mine in the US. Neil serves as a board director of Babson Diagnostics, Sustain Nanosystems, TBT Pharma, and many others. Neil holds an MS in management from the MIT Sloan School of Management and a BES from the Johns Hopkins University. We are also pleased to have Yoav Hochberg, a co-founder and managing partner in NextLeap Ventures. He is a board member and strategic consultant to many startups and multinational corporations. He has over 35 years experience in the development of hardware and software. He is an executive coach and strategic consultant from the Israeli Coaching Association. He holds a BSc in computer engineering and an MBA from the Technion. Dr. Jeremy Krell is also with us this morning. He is a general dentist and the managing partner at Revere Partners, the first and only venture capital fund for oral health. He has since built the Barchester Bay Group, a portfolio consisting of over 30 separate ventures, within which he has held roles such as head of marketing at Simplify and chief marketing officer at Verena Solutions. He is also an angel investor and sits on the boards of several healthcare and dental startups. Finally, we have with us Rajan Luthra, head of special projects in the chairman's office for Reliance Industries Ltd. He has unique experience in envisioning, planning, and executing large-scale technology, innovation, and digital transformation initiatives. Rajan is deeply engaged with global innovation, including startup incubators. Thank you all for joining us today. So just a few thoughts before we jump in. Now, given the unusual circumstances we are facing in the world today, I'd be remiss if I didn't make mention of the big elephant in the room. Can anyone guess what that is? Actually, it's a whole herd of elephants. We have COVID-19, supply chain costs and slowdowns, inflation, and any number of other factors that we can pile on. Now, how has the pandemic, these issues, and the recovery changed our global business community? Now, with the shutdowns last year, investment activity collapsed well into the third quarter. VCs retreated from new investments to focus on their portfolio companies and mainly helped them find cost savings and liquidity, and taught them how to share resources between the companies for best practices so that they can be more efficient together. But by the fourth quarter, capital investments made a very surprising comeback. Maybe not so surprising considering investors were left with a surplus of cash and needed to put it to work. However, the focus of some of those investments shifted. Factors such as geographical diversity, which we think it was driven by the use of technology to create virtual work environments and the ability to compete from anywhere to anywhere in the world. Lifestyle products and services, most likely propelled by the work from home and online shopping trends resulting from the pandemic, and a strong healthcare focus. And this was very similar to how many financial security innovations sprung out of the real estate collapse of 2008. So it's on people's minds, and people tend to spend their time and money there. There has also been a lot of focus given to socially responsible investing, signaling a shift towards responsible business practices and industries that are designed to help the world, typically going under the moniker of ESG, environmental, social, and governance initiatives. Our panel understands the challenges and opportunities of this market and will provide perspective and actionable information to help entrepreneurs succeed. Now I will turn this over to the panelists to introduce themselves and provide their opening comments. Let's start with Alexandra.
Thank you, Michael. It's wonderful to be here, and thank you, Lawrence, for organizing and for inviting me. I'm Alexandra Choli, Alex. I am based in Greece. I'm one of the founders and partners right now of Metavallon.vc, as Michael mentioned. We invest at the very early stages, so essentially the seed spectrum, pre-seed, seed primarily, and then some late seed ventures as well, of technology businesses, mostly geared towards deep tech companies, so mostly towards technology innovation rather than business innovation, and B2B companies. We invest in the region, in Greece and in Europe. We have some investments as well in the US. These are outliers though, so our focus essentially is Southeast Europe and Europe in general. We've been investing with Metavallon.vc for the past 4 years in the region and in Greece, where we've seen a growth in the ecosystem. Personally, I've been involved in the ecosystem since its birth about 10 years ago. So essentially it's a very young ecosystem, to be honest. I've worked in as an incubator initially, then accelerator, and now a venture capital, and have seen this essentially bloom of the country and of opportunities, essentially, especially in the deep tech. And I'm very excited to share my experiences and also hear what all the other panelists have to say. Looking forward. Thank you.
Okay, thank you, Alex. I appreciate those comments and introduction. Neil?
Good morning, everyone. It's always a pleasure to come back and do some things on Long Island. I was actually born and raised on Long Island. I want to thank Stony Brook for letting me use some of their library facilities when I was a young high school student. And I think I was a part of the Long Island Capital Alliance about, close to 30 years ago when I started my firm. So I thank Michael and Lawrence for bringing me back for this. I run Emerald Development Managers. I actually repositioned to Florida, having nothing to do with what you hear about going on in Miami Beach, which who knows if it's real or not. But I run Emerald, which does a pretty much national business in deep tech. And where we like to be is bringing technologies out of universities and building companies from scratch and building companies to become major innovators and disruptors, both technologies and ultimately of how we live our lives. I look at the world and say it's a very big oyster, and the question is, how should all of us be thinking about it? I started with the proposition that I should be based in New York, and what we discovered was it truly is a national and international world, and I think this panel proves that. And I think you have to think about the world that way and think about trends developing all over the world. As we go into, I'm sure, what are going to be a lot of questions that Michael will throw out to this panel, I want you to think maybe about two things. Is any of the technology I'm working on so important that the world has to have it? And how am I going to get it out to the world? Because if you can't answer both of those questions, I submit you may need to go back and rethink your technology a little bit and what you're working on. Thank you. Looking forward to the panel.
Thank you, Neil. Very good points. And I do agree, bringing technologies out of universities and coming from product people and entrepreneurs who are very strong in the technology, but maybe not so savvy on the business side. I think that's something we'll talk about in a little bit. How do you gain that expertise? How do you bring something to a commercial venture and a commercial success? Next, we have Yoav. Unmute, please. Thank you.
Can you hear me now?
Yes, we have you.
Again, thank you very much. Good morning, everybody. I'm thrilled to be here. And again, thank you, Lawrence, for inviting me to this distinguished panel. I'm based in Haifa, Israel. My personal background, so you know where I'm coming from, I worked for 30 years at Intel. I was the vice president for strategic planning and business development. And throughout my years, I have the first patent on multiprocessing. I got $1,000 and a plaque for it. Intel made a little bit more money when Intel was actually growing. I helped get Wi-Fi worldwide, and my team for the product definition of the products that generated over 85% of Intel's revenue between 2004 and 2016. Which means that I have seen when the whole industry was growing up, how technology can change the world. How can you make world level changes by bringing in new technology and transform the way people live, the way people play, the way people age? And when I left Intel after 30 years, we decided, me and several of my friends that worked with me for many, many years, we were 8 partners, to take our learning and actually apply it to the rest of the after Intel. There's life after Intel. And what we decided, NextLeap Ventures, which is a venture capital fund for the employees and the alumni of Intel Corporation. And we invest in companies, mostly early stage Israeli companies. And our focus is very simple. We look at problems. Where are the things that actually address a huge, major problems for the world, which means it's a huge market. And we look for deep technologies that actually are fundamental in order to solve those problems. So we have investments in wastewater management, in digital health, in data center cooling, computer vision, and a bunch of very interesting areas where you really address big problems. But I do want to actually point that it's not just about technology. You have to find the sweet spot, what we call the BUT model, which is the business, the usage, and the technology. Technology by itself is not enough. You have to understand how all of these three things come together in order to invent a technology, but really solve a big problem and generate value for a very large set of people, which would mean you're profitable. And I just, I'm happy to say that yesterday we had our second exit this year. So some of our technologies that we invested in actually really work.
That's great. Congratulations on that. That is great news. And The generate value is one of my favorite words when it comes to entrepreneurship. So that's something we'll talk about a bit later as well. But it is all about the value that people derive from using your products, services, and technologies. Extremely important. And I think people lose sight of that. They get excited by a cool thing that they're doing, the fun that they're having, and they lose sight of the end customer and how they will actually use it and what alternatives they have if they don't actually use your product. So very important point. Thank you. Next, we have Dr. Jeremy Krell.
Hello, everybody. Can you hear me?
Yes, we can.
Good. Well, it's nice to meet you all. And Michael, thank you so much for the introduction. It's really an honor to be here with such an esteemed panel. Enjoy opportunities like this to speak to I've heard dentistry referred to before as a quote unquote cottage industry. And really meant until more recently. Network your way through the field and you realize just how many people know each other within this field. And while some in other fields might find that to be very limiting, I actually find that to be quite rewarding. There aren't too many fields out there where you really can see a roadmap, where you really can navigate them and get a feel for the size and scale of the industry. I have a non-traditional background. I've been called and now call myself a quote reviving sort of a 1980s, 1990s term, the wet finger dentist there. I don't practice too much dentistry anymore, although I do have some practices. I have obviously an MBA and have focused on really the business side of the industry. I have about 18 years in startups. In fact, I started in startups before I started in dentistry. I like to look back and say, that it was all planned. It was not all planned. I was just scratching an itch, following a passion. I had started actually with a web and graphic design company, and I spun 2 companies out of it. After that, I went to a luxury good and commodity service targeting college students, and we sold it 4 years later. Just was luck before 2008 market crash. From there, I went and founded a venture incubator in Boston, scaled it to New York, Chicago, San Francisco. Stepped down to sit on the board and accepted a leadership role at Oscar Health Insurance, which IPO'd about 7 months ago, and left there to become the dentist at Quip. And headed up the entire professional side of the business. And from there went into, as Michael said, the Barchester Bay Group. So just providing that additional color and texture to say that not every road have often bumps in the road, they have curves, and that's what we do. At Revere Partners, which is the first fund focused on oral health, and I was really surprised as a dental entrepreneur myself, with maybe 12.5 investments in this space, at least 6 board seats in this space, that there was no VC fund focused on oral health, and so took that opportunity. And there, I think, are several really key and important growth areas in oral health to think about. As we see them, there's tech and SaaS, and there's lots of sub buckets under each of tech. There's consumer products. There's the fin or pay tech area. There's the access to care / prevention space, and then there's this area of oral systemic health links that have developed, and many trends and many company types and subtypes within each of those buckets. So it's an exciting space. Even on the PE side of the industry, you're seeing offices consolidate with turns on EBITDA between 13 and 17%, which are pretty high from a financial services sense, and even from the PE world. And on the startup side, you're seeing raises, in the area of anywhere from 30 million to 150 million at valuations, anywhere from 130 million all the way through, over $1. Very active space. There are transactions occurring weekly or every other week, and it's a really great time to be part of dental innovation. Thank you, and I'm looking forward to the panel.
Jeremy, thank you very much. I appreciate those comments. And passion, another very important word when it comes to entrepreneurship. I think you've already seen it in the people we have here talking with us today. Rajan?
Good morning, good afternoon, good evening, everyone. I'm here in Mumbai, where it's already about 6:30 in the evening. I represent Reliance Industries, which is India's largest enterprise with oil to chemicals, retail, digital services, and media and entertainment businesses, with revenues of over $73 billion last year. We are strategic investors. We are actually, let's say, a company that looks for startups and others for strategic investment and integration for some of our businesses. Reliance Retail, one of our businesses, is India's largest retailer with close to 13,000 stores all over India in multiple formats. Jio, which started commercial launch about 5 years back, a little over 5 years back, is the largest telecom company in India with 430 million subscribers, all 4G subscribers. Recently, our chairman, Mr. Mukesh Ambani, actually announced a major foray into new energy business as well, with investments of over $10 billion being committed. Personally, I've been involved with almost all the hydrocarbon and consumer businesses of the company over the past 22 years, out of my 31 years in the corporate side. And I'm currently building digital platforms and services and also some path-breaking integrated operation center. Coming to the investment side, I represent Reliance on the investment committee of a Jerusalem-based incubator, early stage Israel Innovation Authority sponsored incubator, where my focus is really on driving early stage investments in frontier technologies. Again, taking from some of the other panel members what they said, we look for passionate founders attempting to solve large-scale problems which are leveraging innovative fourth industrial revolution technologies. And I think for today, I would be sharing my perspectives as a strategic investor in tech startups, having been involved with over about 20 investments across India and Israel. Thank you.
Okay, thank you for those comments. We've heard some of that same stuff from the other panelists as well. Large scale problems, we're solving big problems. I think, again, from an investment trend standpoint, I think that is a very big thing now. People are looking to be, environmentally conscious, socially conscious, and trying to, help the world be a better place, and then make it obviously a commercial enterprise where we can all make some money, employ people, and kind of grow for our investors. So with that said, I think now we're going to move into kind of a structured discussion at a high level about some of your regions. But again, remember, this is a conversation, so please feel free to jump in, add your thoughts around this. So we'll start with just some general comments about what is the investment climate for your region. What is some hot industries? What dollars are available? I know you've touched on some of this at a high level, but let's dig into some of those deep technologies. Let's understand where people are looking to make their returns, where they're spending their money, and then any thoughts around how long that process takes. So why don't we start with Alex, and then we'll go from there.
Sure. So I can talk for Greece and for the general, perhaps, region, Southeast Europe mostly. I would say from our side, first of all, we are sector agnostic. So we're not looking into a specific sector, but mostly to what perhaps the other panels also mentioned, the teams and people solving important problems. And I think it may be, interesting to stress here why we're looking for important problems or technologies that essentially help solve a problem in a way that is, let's say, 10 times more. And I'm sure that people may have heard this 10 times more, but I feel it's very important because in order to get someone off their comfort zone and to adopt a new technology, a new solution, you kind of need to essentially bring a significant value, a significant added value to their daily lives or to their work. So what we're seeing, especially in Greece, because again, it's a very young ecosystem, it is investments across all sectors. There are interests in areas that Greece has some expertise or has talent, has a great raw material, let's say. So people that have the expertise, and that would be in the areas of energy, in healthcare. We also have a semiconductor, a small semiconductor industry that is a little bit unknown, but in fact, one of our recent exits was in the semiconductor industry. And then there are we see a lot of activity in mobility. And then in marketplaces, as in general, let's say, as in business innovation. This is something that we personally look less, but we see a lot of activity in Greece and in the region around this, as there is around digitization, let's say, of operations in general. There is a lot of opportunity and ways to go compared, for example, with the US, where we see a lot more advanced solutions there. And I'm sure that perhaps Yoav, if you are also looking into Europe, you may have some insights in the European market to add to this.
Right, so we focus mostly on Israel, and again, Israel was coined a startup nation, and the country is undergoing a very significant change, trying to move from a startup nation country to a scale-up nation country, because Israel, with only 9 million people, is not a market. So the companies, the startups that are starting to work in Israel have to think globally from day one, because you can do a great proof of concept in Israel. You can't build a market, you can't make a significant amount of money. So you have to think about the world. And if you take a look at the last 2 years, during the COVID-19, $10 billion were invested in Israel in 2020, over almost $18 billion in the first 3 quarters of 2021, and there were 19 billion of exits. Israel actually has the largest amount of unicorn per capita world today. Okay, it's not a lot of number because only 71, but still per capita, it's a very large impact. And so the ability to think about things upfront globally, to quickly and be able to try and address, bring the technology. The Israeli ecosystem is really built on 4 major pillars. It's the academia, it's the government, it's the and multinational. We have over 450 multinationals here in Israel from every sector. Of course, many people actually have to deal at a very young age. You have to spend several, sometimes even more years in the army, and you learn to, and the army actually has a very interesting saying. It tells you, this is what you've got. No one is going to help you. Don't complain. And if you don't succeed, you're going to die. So basically, you have no choice. You innovate by no choice, right? So, and that's a mentality which actually says you have to do what you have and get the maximum out of it. And that is why, if you take a look at the Israeli investing, the seed round and the A rounds are significantly lower than the US from a valuation. When they exit, they are on par or even higher. In the US, only 8% of the companies actually become exit. In Israel, it's 12%, and they run significantly linear, which means they do spend less money throughout the process. So this gives investing here in some of the technologies and the companies an advantage of about 30-40%. Now, will it continue? And as we see, like Alexandra was saying, Israel started really early because of the focus from the government, but this is not a sustainable competitive advantage because everyone else is also learning how to do it and running as fast. So there's a saying, in one of the movies here in Israel, is that the way to win the race is to start running as fast as you can and then slowly increase the pace. What you have to do in order to stay competitive.
Okay, I
But
love
again,
those comments.
Rajan, you actually have, coming from the outside, you have an interesting perspective on our space as well. So I'd love to hear your perspective. Not looking at it differently than probably the way I'm looking at it.
No, you're absolutely spot on. I think that's the reason why I've enjoyed my last 4 years working in the Israel innovation ecosystem as well. Very passionate founders and very committed to problem solving, as we say. But I think just at a more macro level, I think some of the other commonalities that I can think of, right? There's a lot of growth and friendship happening between India and Israel at a strategic level in any case. And we believe, Israel is the startup nation trying to be the scale-up nation. India is where the market really is, right? And I think if we briefly see what's happening at an overall level, despite the pandemic and everything else, the economy is still doing fairly well. There is a lot of, let's say, challenges around, but by and large, I think it's not too bad given what could have been. At a more macro level, coincidentally, India environment, if I was to briefly touch upon that, Michael, with your permission, we basically have coincidentally a similar number of unicorns right now. So there are 71 unicorns in India. Almost half of them were created or announced this year itself. So the amount of funding that's coming in last year was $10 billion. This year is obviously going to be higher than that. And I think we are a few years behind in the curve in terms of where, let's say, the US or some of the European countries are in terms of the startup culture. But today, India has over 50,000 startups registered with the government of India's Startup India platform. And many of them are genuinely now working on addressing not just the typical consumer-facing solutions or consumer-facing businesses or even the SaaS businesses, but many of them are actually now focusing on, let's say, using, as I said earlier, the fourth industrial revolution technologies to solve key challenges. One of the areas where I've been working very closely is the area of drones for the last few years. I chair a FICCI committee on drones where we are supporting the government on the regulatory side on one side, but also helping the startup ecosystem engage both with the venture capital and the investors on one side, and on the other side with the, let's say, the large end users. But I think interesting commonality of some of the trends that we see across India and Israel.
Okay, thank you, guys.
Yeah.
Appreciate the comments. And I think that gives a great perspective across several of these regions. Jeremy, is there anything you wanted to add to that right now as well?
Yeah, I was just going to add, Revere Partners is global, both in its investor base as well as in its startup base. So we actually watch, plenty of other markets. We have, in particular, seen a lot of activity out of Israel. We have an arm of Revere to address the Israeli market in oral health because it's so active, a partnership with the Israeli government. We have seen a lot of activity out of India and China. We have seen a lot of activity out of Brazil and Australia, and out of several areas within Europe. Switzerland, Germany, the UK in particular are all very big and active dental markets. So we not to say that that's a comprehensive list. We see a lot of ventures and a lot of investors, but those are definitely countries where we see a lot of activity. I would say there are several developing trend areas, if you than the 6 buckets I initially outlined in my introduction. Not at all to name them comprehensively here, but a couple of the big ones include, for example, AI in dentistry has been a very, very tight spot. Looking at it and it's a loaded term, right? Because AI can be, and machine learning can be applied in multiple different ways to dentistry, not just one, but this area of radiographic diagnostic assistance has risen to everybody's attention. The area that Denti AI and Pearl and Overjet and Vidya Health and Diagnicat and Apteryx and so many others are trying to address. Another key area I think that's visible to the entire world is that of aligners, right? And aligner adjacent technologies. So everything from, right, obviously Invisalign, Smile Direct Club, but also Candid and Candid Pro, looking at, going on Dandy, looking at monitoring in the continuum of aligner product. And, for example, another key area is this area of biome or microbiome, right? The bacteria in the mouth and what it can tell us and how we treat it, right? Here kind of looks at that as a progressive area, right? A 3-step process where there are companies focused on engaging and educating consumers. There are companies that are really true diagnostics that tell us the quantification of the bacteria that are there and which ones are bad players. Kind of the third part of the trifecta is the treatment modalities to actually treat the problems that each individual has, right? And so these sort of are, end up forming subcommittees with inside of Revere, where there are multiple different companies approaching these spaces in different ways so that we can sort of comprehend and make sense of those areas and how to support them. So in activity from many different countries, and also around several key growth areas within dentistry and oral health.
Okay, that's great, Jeremy. Appreciate that. Neil, any further thoughts on this topic of the investment climate?
I have to speak as the person really just on a broad base here in America. I feel sort of obligated to do that. We are living in a time of excess in venture capital. I think many of us feel that there's so much money being thrown at the ecosystem here in the United States that what Yoav was talking about is really who have to make do with less are in a very different position. It's very interesting. And right now, we're not sure it's a plus or a minus. I think for this audience, the most important thing to do is to ask yourself the question of, am I spending my money properly? Am I getting the right venture capitalists who will help me spend it properly? Because you're no longer spending government grant money. Many of you here are used to spending NSF money, NIH money, ARPA, DARPA, pick your acronym of government money that you get your research grants from. It is very different when you actually have to do it. And every time you're spending money, you're diluting yourself. Now, right now, there is more money in the US venture capital system than anybody could fathom. It is so much that in a way, I'm going to argue it's almost counterproductive. And I see Rajan, I think, is agreeing with me. It's kind of crazy. And what we keep telling our companies is, you better assume that it won't last. You better assume that you really have to focus on getting your technologies out of the lab into the hands of the customers quickly, efficiently, and in a way that they have to come to you to want the product. I think that right now in America, you can get almost any dumb idea funded, and it's pretty strange. Now, that is more true in areas that are software based, for lack of a better word. I think if you're going to look at companies in the United States, the easiest thing to do today is to start a software company that's going after a business model as compared to going after real technology. I think that's a fair statement. I think, however, that people who are doing what I'll call deep tech, real science-based and science-driven, first of all, it generally takes longer and costs more money. We do a lot of companies based on materials science. We do a lot of companies based on real technology that you have to get through the FDA, and you can't just do an easy 510K. Those take a lot longer. even people who are trying to do machine learning, AI, whatever you want to define it as, it takes a lot longer to get those things through and are a lot trickier to get those things through the FDA than anything else you can imagine. So I think what I'd like to do is caution those of us who are focused on the US market to remember that markets change and markets move. Right now, if we adopt the mentality that Yoav was describing in Israel, where you have very limited resources and you have to make do with them, and then talk about the fact that you have to get it into the market, get it out of the lab and into the market, I think that's the important thing that this group would like to focus everybody on. And we've all said it in slightly different ways, I think. But I think that even if you're in the US, which has more money than it knows what to do with in venture capital right now, that's the critical issues. And that will define how much you as a founder and you as an entrepreneur can make as you're bringing your technologies to market.
Yes, thank you, Neil. Appreciate those comments. And I think you're exactly right. I think there is a lot of money out there. I think people are searching for some of the things that you've all talked about, that really impactful idea. The unicorn concept, and for those that don't know, unicorn is a company, a startup that's assessed at $1 billion valuation in early stage. But we've talked a lot about deep tech, which again, it's new offerings in engineering, innovative offerings, or scientific discoveries that have a big impact, right? So these are the things that a lot of venture firms and a lot of investors that I talk to are focused on. Deep tech can be challenging at times because it has to have a big impact, but sometimes it can take a long time and it requires lots of capital. So it, again, goes to some of the points that you've already made, in that you've got to run fast, start running, run fast. You've got to try to get things to market, proof of concepts, pilots, things like that, to show that it will work and provide value. And it's things like that will continue to attract interest, capital, and get you to kind of a commercial success and a self-sustainable, profitable entity much sooner.
And one thing I'd advocate for anybody who's looking to raise venture capital in the United States, look at the portfolios of the people you're approaching for capital. If they haven't done deep tech, they're not going to start with you in all likelihood. It is much easier if you're a venture capitalist to throw money at software companies and keep going. Okay, you get markups faster in your portfolio. Your investors think you're a genius, and in the long run, are you a genius or are you not is a relative issue, but it's something that you as an inventor, as a scientist, as a professor, if you're on this video, if you're listening to this forum, you're doing some serious technology. And you're probably not doing something that's more what I'll call pure business model focused or pure community focused. I mean, we've all seen the rise of Facebook. Now, yes, there's a technology underlying it, but is that the kind of technology that you're going to have done day one? Now, you may end up building a company that they desperately need the technology from. And we have looked at companies which they've ended up buying the technology or licensing the technology from a university because we made the decision and other venture capitalists made the decision, okay, this is going to take $1 billion and 10 years, and it might be the right answer, it might not. And Facebook said, you know what, we'll add it to the 20 others that we're buying this week. It's a different approach. And you have to figure out who and what are you and what are you looking for, and match your needs to what the venture capital firm is looking for.
Yes, thank you, Neil. I think that's a very smart point. If anybody wants to add to that, the thing about that is that it is a sales process. If you think of it that way, when you're trying to find partners, and as you mentioned, you need to look for partners that will help you versus people that are just going to look at the financial statements, every month, every quarter. Getting their attention is really about being targeted, just as you said. You want to find people that are interested in what you do, that do what you do, because there's a much higher probability of them being interested and involved. Every minute you spend with somebody trying to sell them something that they don't want is wasted effort. And as entrepreneurs, there's very little time to waste.
Actually,
Yeah,
I'm. Go ahead, Rajan.
Go ahead, Yoav, after you.
I teach a class in the Technion about entrepreneurship and funding, and I give the fact that an average startup actually stays private today for over 10 years, while the average length of a marriage in the US is 8 years. So when there's only a 1% chance startup will actually succeed. So when you're starting on a venture, you are choosing people that you will spend more time than you are with your spouse for a longer time. And actually, you have to think about it. This goes back to what Neil said, which is about choose the right partners. Because having been in startups as a strategic investor in Intel Capital, as a board member, as a VC, having sat on all areas and probably touched, like many of the people here on the call, tens of thousands of startups. There's this what I call the 5 necessary but not sufficient elements that startups utilize to succeed. It means that most of the ones that did actually had them. It doesn't guarantee that you have them. It actually provides success. First and foremost is the team. If you don't have the right mindset, if you don't know how to operate in the volatile, uncertainty, complex, and ambiguous, the VUCA world, that exponential world that we live in, if you don't have an entrepreneurial grit mentality, with a growth mindset, and that whole team has to be like that, then it's going to be really hard to succeed when the world changes around you, and it's going to change a lot in the coming 10 years. The second element is that you are really addressing a real problem, not a made-up problem, not a technology looking for a problem, but you've really identified a problem that people have. There's something that is called the equilibrium of the uncomfortable equilibrium. People know how to sit a little bit like this because they don't change it. So there's this solve a real problem that people really have a problem with, people, businesses, governments, countries. Then you need to have a sustainable competitive advantage based on technology. Okay, that is what we are looking for. There is time to market. There are other advantages, but we believe that technology is a good, sustainable competitive advantage. AI is not a technology. AI becomes easier over time because you can. If you're a high school student, you go to Google, you can run AI. 5 years ago, you had to be a doctor in order to do machine learning or computer vision. Today, anyone can do it. So even the competitive advantage of a technology is limited. Then you need to execute because, one of my former bosses said, execution is king. If you don't know the KPIs of your business and you don't consistently meet them, the fact that you have great technology and great doesn't matter anything. And last but not least, you have to achieve scale because you want to make a lot of money. If you can do one and write a paper about it, stay in the university. But if you want to get into a huge business, you have to put scale. So these 5, the team, problem, the sustainable competitive advantage, the KPIs and the scale, those are what I call the 5 necessary but not sufficient, which you need to take a look at them as you set up your operation and move forward.
That's right. Rajan, did you want to add something to that?
Yeah, I think just maybe adding to what Neil was mentioning, right? With so much of money floating around, what should entrepreneurs look for? Just on the other side. So we have talked about what does he look for as an investor into startups. I'm saying on the other side, I think that's another topic to discuss as well as to between, let's say, with the money on one side versus what is the support that the investors are going to give you rather than just expecting you to grow rapidly. So there is going to be a huge amount of pressure coming up on the growth as well. So when you choose your investors, please do that wisely, right? What is the value they are bringing to the table, especially if you have a choice like the US situation at this point. It's a similar thing happening in India in some ways, right? There's a lot of startups which are getting targeted in the hot areas. But what should an investor, what should an entrepreneur look for when you're having multiple choices of investors? I think to me, the alignment from exactly number one, which is the focus area, what is the support being provided, which are the, let's say, value add that they are going to be able to provide in each of the 3 or 4 areas out of the 5 that you have mentioned about? Especially, how do you help the startups become more mature and scale up and execute faster?
Yes, completely agree. Why don't we stay with this topic on sort of the criteria, what you look for in companies, because I think that's the thing, again, that people need to be out there for, and then adding the additional comments as Rajan has around, what the investor needs to look for in a partner as well.
Yeah, I can add to some building on what others have said, and then meat on the bone, so to speak. From the entrepreneur side, totally agree. Looking at the portfolios of the VC funds, you can also look at the the investor sets that invested in your competitors and figure out sort of who are the competitive or similar VC funds to them. I've seen a lot of startups do that. In addition, I like others have said, there's a lot of money out there, but who is the strategic money, right? Who is the money that is really gonna help you bring your business forward, right? Do they have significant expertise on their team? Do they have significant networks within areas that you're growing into? Can you basically grow with the fund? In other words, you're raising a round now, you're going to need the next round somebody to come in bigger, able to just coming in this round. So I see entrepreneurs starting to think a little bit more strategically about the money that they bring on. Not to give funds more work, a lot of work with our inbound leads. Revere has, for example, 200 oral health startups in its pipeline. I'd say over 85 in active diligence, and we invest in 3 to 5 per quarter. That takes a lot of work. So I'm not inviting more work necessarily, but for startups that wouldn't be a fit, as we exclusively look at oral health. But in general, the VC funds do have a process as well, some more sophisticated than others. At Revere, for example, we have a sort of there. Are you focused on oral health? Start to be the beginning of it. Then there's an intro meeting. Following an intro meeting, there's typically a pitch with what we call a diligence team that consists of 1 general partner, 1 venture partner, associates or experts of ours. From there, if there's mutual interest, there are typically breakout sessions around certain deeper areas of diligence. So it could be financial, could be clinical, could be technical, could be financial, could be manufacturing, distribution, depends on the type of startup you are. And then, pending mutual interest, if all questions are then answered, our team has an internal proprietary scoring methodology. And then there's a, sort of presentation by the venture partner level up to the general partner level to ultimately make that decision to invest. So it's a holistic end-to-end process. It takes a lot of looks at the startup, and ultimately, comes to a decision. In general, what you have to understand, there really has to be a good fit. Now, Revere is kind of unique in that we don't necessarily focus by industry, not necessarily by type. On SaaS or biotech, Revere actually sees Revere all of those types of ventures. It's been suggested here on the call before, how do they return? I can speak to that, in oral health specifically. We actually, before the fund, we put together sort of the pitch book of oral health, right? There was no, what I mean by pitch book is, a huge database of companies that have returned. That information is not widely available or centralized pitch book or anywhere else. We access 600 companies actions and built an infrastructure on top to be able to query that database so that we can benchmark valuations and also provide insights back to the industry. It's actually a very lucrative space. They return typically about 4.1 to years, about a 5.1 VC fees. IRR is about 33 to 35%. So compared to tech and compared to oral health startups, if you know what you're doing as a VC fund and investor, can actually be very, very accretive to the line. So the return profile is quite good, and we happen to look in different areas. So, those numbers I gave are highly averaged, right? In other words, as suggested before on the call, a software startup is going to be more like 3 to 4 years return, right? Whereas a consumer product, maybe 4 to 5 or 6, whereas a therapeutic or device is going to be more along the lines of 7 to 10. So there are a lot of major differences among the areas in terms of what Revere, or I think in general VCs tend to look for, and we categorize it in a bunch of different buckets. I think is a huge one, especially the earlier stage. We invest probably 2 to 1 Series A to seed stage ventures. We do a little bit post Series A, do a little bit pre-seed, but always team is very prominent, right? In other words, what is their experience? Are they well-rounded? Do they have vision? Right? We look at the product a little bit, right? Is it proprietary? Is it differentiated? Is there a good product market fit? We look at the market, right? Is there growth in the market? Is the timing right? Right? We look at competition. Are there barriers to entry? Is there, excitement in the area, right? We look at the business model. What are the unit scalable? How do the financials turn out? And we have, of course, algorithmic ways to approach this as well, but, high level risk. Are there big legal risks, capital risks? And then ultimately, what's the exit potential? So these are some of the areas that we tend to look for.
Okay, Jeremy, thank you. I appreciate that, and I agree. It always comes down to team. The first, second, and third criteria behind intuitive idea that solves a real problem, and how to get to market. So those are great points. Alex, your thoughts on this?
Sure. So Jeremy covered, I guess, the high level and some details about the criteria, and it's spot on. This is again what we look into. So essentially, we would categorize, let's say, in 5 areas, and that would be technology for us, since it's technology innovation that we're looking into. So there's defensibility as well, issues there that we're looking for, not necessarily patents, but patents as well. And so it could be trade secrets or something that is not easily copied. And then we have the product, again, as Jeremy mentioned, the business, financials as well, and then investment related criteria, like even the cap table, for example, or areas in general that have to do with our investment as the exit, again, mentioned before, and of course the team. So the team essentially, and we give different weights as well in this criteria, and the team, I guess, has, I would say, the highest weight, that there are different areas that we're looking into. So especially, again, for deep tech ventures where technology is the differentiator or the most valuable, essentially, element, we would be looking for expertise in the company. So it cannot be that the technology is developed outside of the company, as it may be, for example, you can outsource it for business innovation startups, but not for technology innovation startups. And it should be to the founders, the expertise of the founders, and how well they know the technology, their product, and of course some insight in their market. Now to what a little bit what was mentioned before from Yoav and from Rajan. I've also done a little bit of teaching in my incubator and accelerator days, and there are interesting, I would say, things that we developed so that we could explain, perhaps, especially to deep tech founders at the pre-seed stage. So when they're looking to put together their product and enter the market, and the importance or the difference between technology, which is, let's say, this small part of the business, then the product, which has both, let's say, tangible and intangible elements. So the value that you offer your customers, or even how the customers interact and use the product, and then the business. And the business has so many more elements. So of course, how you, so it's your marketing or your go-to-market essentially plan, your financials, your people, the people that you work this is so much more complicated, of course, and so much more than just the technology. And it's in businesses that investors invest in. So it's important, of course, to have the technology, but you have to have figured out, at least have a very good hypothesis and a good first plan for all the rest, even at the pre-seed stage. And also to what was mentioned before, there is this question that I usually share with the audience, and there is this axis, let's say, of the value of a company, and then a blank axis. And there is, let's say, the value of the startup just going up. So what is this axis? Most time, the first answer that we get is time, which is, of course, not right, because if that was right, you would get a company, you could put it on a shelf, and after 2 years, the value would have exploded. So the axis here, the value of this axis is essentially execution. It's what Yoav mentioned before. So it's the one thing that will help increase the value of your business, and that's the most important thing. And we look, even at the pre-stage, at the pre-seed stages, we look for evidence of execution and how you've moved forward and how you have validated, even without profit, the value that you're saying with your target market.
Yeah, maybe I'd like to, it says that theory and practice are the same. In practice, they are not. Okay, and if we take, what I heard from Jeremy and Alexandra and Rajan, we all look basically at the same things, because there are, hundreds of thousands of startups that were there. People know what actually succeeded, and there's a lot of knowledge, but there is a lot of responsibility on the people who built the entrepreneurs themselves. We as a VC or as an investor, we do what it's called, collectively, we do the due diligence. All of those things come together into the due diligence. And if you think about it conceptually, from the minute you meet a company until about the term sheet, you think about, why should I invest in this company? After the term sheet, you actually look for all the reasons not to invest in the company, mostly legal and financials and all of that. But throughout the whole process, you are also looking for what can be an indicator to not invest in this company, because there are so many companies out there, and there's so much, you don't want to just spend your money. So the entrepreneurs have to understand that every single interaction of the entrepreneur with the customers, with the investors, is part of the due diligence. If I come into the offices of the company and it's a mess and people are shouting and they don't get along with each other, it doesn't say good things about the company. And so you have to understand that the process, all the parameters, it's not just that you tick one off and then you're done. It's a continuous process. From the first time you meet the company, you're starting this process, and until you wire the money, that process continues. And you have to understand that this is the way we look at it from our point of view, but the entrepreneurs have to understand that it's the same, that this is what's actually happened, and they have to internalize it and make sure that they are using everything that they can to actually prove and show the value, the execution capability, the fact that they can get together, the coachability of the CEO. From our point of view, if there's a great CEO but does not know how to get comments and does not know how to take advice, he would have a problem succeeding. So there's just not a full list, but I think that is a very important element.
Yeah, again, excellent points. Just Alex, just to kind of comment on the execution part, and Yoav, you mentioned this as well. Usually the companies I work with and that I've run, we operate under a philosophy of focus, alignment, execution. Focus is prioritization. So, do the things that are important, not the things that come across your desk. Alignment is getting your teams going in the same direction along with the market, including your investors and other partners. And then execution, obviously the most important thing, because anybody can write a good business plan. Anybody can have great communications vehicles in place, but actually executing upon your idea and moving it forward every single minute of every single day is the key. And when I look at execution, I look at it as empowerment? Are you giving your team, however big or small, all of the tools they need and the vision and direction they need to get their jobs done, and then holding them accountable? And accountability is not just the hammer of, you didn't do your job, you're going to get in trouble. It's also the reward system, right? Are you accountable for the results? Do you get rewarded for good results and otherwise? So part of it is, the human aspect, the motivation of moving it forward. But again, execution is the key to succeeding as an entrepreneur, outside of all the other things. And then one just last comment before we kind of shift topics here. I get probably 3 or 4 business cases that run across my desk every week. I bet you guys get 100 a week. As investors, we always look for reasons to say no, because there's so many ideas out there, and that one thing, the management team, the challenges or issues that they have, other things about their inability to understand their business, their KPIs, their direction, their forecasts, right? These are all reasons to look at something and say no, because you have another 99 ideas right behind it that you can invest in. So from an entrepreneurial standpoint, it's important to understand that, you need to know what you know and be confident, and you need to know what you don't know and admit to that, but then go figure it out, right? You can't fake your way through this. There are way too many smart people who don't put their money just anywhere, and they do spend the time to dig into your company and figure it out. So with some of those thoughts, I think now what I wanted to do is kind of flip this over to Larry for a minute. Larry had some other more detailed questions on some specific topics that I think will advance our discussion here. So Larry?
Thank you, Michael. In dealing with it's very, very timely that you do so, because in dealing with that avalanche of companies coming in, I met an established investor about a year ago who had actually developed their own database-fed in-house artificial intelligence algorithms to help them do the initial screening. And they had developed metrics that showed them, to their satisfaction, that this had really helped them. Is this a technology that has interested you? Have you done any application of this in your work?
Lawrence, personally, from our side, we have developed something like this for screening as well, and not with the use of artificial intelligence yet. It is more algorithmic, and essentially it raises flags in order to help us screen out companies that may not be a good fit or may not be at the stage that we want, or they're outside perhaps of our scope or of the geographies that we're looking at. I feel for the very early stage that we are working, it may be harder to use data. I know that companies Series A plus, they use databases and data at the moment with the support of our artificial intelligence. I feel it's a new trend, and it's easier because you can use, for example, financial data and the digital footprint or the internet footprint, I guess, of companies that have existed for some time, and so there is data to be used. In the very early stages, a lot of companies that we see, for example, that are coming out of university, they have not, sometimes that they haven't had a running website for some time. Of course, there are no financials. So the data that you can use in order to evaluate them, it may be more difficult to collect, or they're just not there.
Thank you.
You know, the value of your the quality of your model is just as good as the quality of your data set. And if
Absolutely.
your data set is not good enough, then you can't do. Now I can maybe add it, because we operate slightly different than regular VCs. We work in cycles. We do 2 cycles a year. In every cycle, we look at 1,000 companies. There are over 7,000 startups here in Israel. So we look at 1,000 companies and we narrow them to 5. And we use the tools and methodologies and all the processes that were discussed here to do so. But then we add an incremental stage where we take these 5 companies, we bring them to an evening, what we call the pitch night, that has between 150 to 200 I call them former and future former Intel employees, from every aspects of marketing, finance, HR, manufacturing, hardware, software, whatever. These five companies pitch to the wisdom of the intelligent crowd, they rank them 1 to 5, because usually in Intel you have ranking and rating, and then we invest in. So what we do, the investment committee, which is the 8 partners, which as you know have 250 years of experience, choose the 5. All of them are investable. But since each one of us is a little bit, has its own fixation, his own limited way of looking at things, adding a wide perspective of so many different people adds an incremental, hopefully, an incremental element that improves the quality of the selection. This is what we believe actually, and there are companies that I wanted that we invest in, that we chose them as part of the 5, but the crowd actually preferred another company, and this is something that we utilize because we don't know everything. So it's an interesting step that we believe that it's giving us value in the results that we see from those companies.
Very interesting.
We've also invested in some infrastructure here. Our team is 65, but the pipeline is overwhelming. Like Yoav, we're a little bit unique. We work within, so make 3 to 5 investments per quarter. So that's quite a bit of movement for a VC fund in a year. And so what really kind of forced us to invest, I'd say 3 things kind of forced us to invest in this space. Number one, we're developing really proprietary technology, our so-called kind of secret sauce, in how we make matches and decisions. We decided to self-grow this technology. Number 2, due to resource constraints, simply having the amount of people to source and look through the demand of startups is another. And I think the third is because ultimately we're fiduciaries to our investors, right? We want to be doing the best job by them that we possibly can. And so we employ, again, kind of more like Alex mentioned, more around algorithmic versus AI or ML today, but we use it in a few ways. First of all, when we match with it, first of all, startups, we use some inputs that we look at. Secondly, match those startups with a diligence team. We use various inputs in an algorithm. When we score those startups, either at a general diligence level or a deeper understand, invest how investable or not. We use a method. I don't think there's any escaping, though, having the human in the loop, so to speak, right? There are a number of different, as have already been mentioned on this call, sort of soft skills that will never be, adequately accomplished, by an algorithm or AI or ML, right? These elements of team, which the earlier the startup, the bigger, amount of the decision is made on that, are much harder to assess. Than some of the other more quantifiable metrics. What is your revenue? What is your EBITDA? What are your, right? These things are numeric and quantifiable, qualified elements of the startup. So we do employ various different technologies, but always with a human in the loop.
Well, I personally think that AI has a long way to go before it will replace, it will be market significant versus human buying decisions.
Jeremy said never say never, but we still have a job. We still have value.
Well, thank you very much. And I mentioned partly because CEWIT and Stony Brook University in particular are strong centers of developing AI technology. One more question from me, if I may. Obviously, when and if you decide to place an investment, the subject of valuation is an important one. I personally have limited experience calculating valuations for companies, but I wanted to know what methods you tend to use in coming up with a valuation or valuation range.
I'll try going first on this one because it's such a weird question in a way. And the answer is even weirder, is the problem. Valuations are completely all over the place. Valuations partially reflect geography. So I will be very honest, valuations are higher in California than they are on the East Coast. They're probably somewhat lower in Israel, although I think there are sectors, which is the next area, there are sectors where valuations are completely out of control, like cybersecurity, where an Israeli cybersecurity company is two guys who have a bright idea and they get $1 billion valuation these days. That's only half a joke, by the way. So it's very, very specific to the company. Companies that are doing heavy duty technology, that are doing anything hardware based, people have to take a lot more into account because it will take a lot more capital and a lot longer to get there than if you're doing something software based where it's three guys who can get, time via AWS or something like that. And so we're seeing, and we do a business that ranges across cybersecurity to technologies coming out in material science that are, we've been watching them for 5 years. They have 3 years before we'll even have a prototype ready to show people. We are seeing valuations running a complete and total range. They're industry specific, they're team specific. If you think people had some struggles with the last question about what do you do with an AI approach to picking companies, this one will give you an even bigger problem. Companies that are raw startups, which is where I think this crowd is focused right now, in terms of the audience here. I think it's very specific to exactly what type of company it is, how built out your management team is, okay? Because if you're the classic one guy walking out of a lab with something, you're going to get a different valuation than if you've put together a team, a real business plan, and how far along the way you are. So not all seed rounds are created equally. Not all management teams are created equally. And those all impact it. So we do not have this, we don't really have an algorithm to do our seed rounds. It's very much more very specific. Do I really, really want to do this? And what do I think is fair given where they are and how long it's going to take us to get to the next inflection point? If it's a software company, or because AI is just a form of software as far as we're concerned, cybersecurity in a way is basically a form of software. You're going to get to your next inflection point much faster than if it's if it's something that's hardware based, or if it is, if you're going to do a new semiconductor, Yoav can tell you way better than I can how long it takes to do the next semiconductor. But anytime we look at a semiconductor project, we hold our nose because we know if anything goes wrong in the first turn, we're screwed and we got to put up a fortune more. And so you have to take all those variables into account. And that's how we try to do these. And what we're trying to do is make sure our management teams are incentivized, and we always understand they will get more equity as you move forward over time, because we will refill option pools. We will grant more and more options as we go on. But we know that our valuation for what we came in with on that first round, we know that's the only thing that is not going to change. So as we move forward, we know we can fix what the management team gets in options. We can't always fix it for ourselves. So it's sort of a trade-off, but I think it's very industry specific. It's very how much capital you need specific, and it's very much team specific.
Yeah, I agree with Neil. And actually, this is why, in some of the cases, you actually utilize in the early stages, use a safe and not an equity round in order not to have the discussion and not to fight about that thing. But I think there's also, Paul Graham said, the Y Combinator founder said that funding a startup is like driving a shift car. You have to reach the right speed before you change the gear to the next gear, because you cannot start in fourth gear and you don't want to drive 100 miles an hour, on your first gear. So, and a company goes through, POC, product market fit, repeatability, scalability, and then repeatability stages. And you need to know where you are in which cycle. You have to know what is the next stage that you need to raise to get to, and what is required to get to. So there's a lot of responsibility on the entrepreneur himself, because if you're able to get $100 million valuation on your seed round, I'm not sure that it's even good for you, because you will not be efficient. It will be really hard to fund the next round. Nobody would want to get in, and you might have the, you would look. So on one hand, there's a lot of money, but you have to be really responsible to understand what are the needs of the company, understand what would require you to change the gears at the right time. Yes, take a little margin. When you are able to raise. You need to raise when you can, not when you need, because when you're running out of cash, that's not the nice. It's not the fun time to raise in. But all of these come into play, and the founders should really be careful not to take too much of a high valuation, not to raise too much money. You need to know what you are doing, and be able to have that discussion and understand the reasoning of why you're doing it, what are the assumptions that you're making, and have that kind of a discussion. Then you can reach a valuation range, amount of money raised, which actually makes sense, that there is a plan behind it, and it's not just because, hey, there's so much money, I'm a really big shot, I did 2 exits, give me a lot of money, I will do something with it. And I'm exaggerating to make a point.
Yeah, I can build on some of this as well. Setting a valuation for a startup, especially an earlier stage one like a seed stage startup, is a dart in the darkness at a dartboard, right? Trying to hit the bullseye. It is a tough thing to do. It is just as tough for those that are highly quant and analytical as it is for those that are less so, because sometimes you're just not dealing with a lot of information. Do we see different methodologies out there that startups use? Yes, we see discounted cash flows. We see XNPV methods with multiples on EBITDA. We see a lot of different, common valuation methods applied to this space. But again, you're to an area where the inputs are, generally speaking, incomplete. I agree with the previous comment. I'm seeing more and more safe notes as well as convertible notes because they delay that conversation around, valuation. A relationship going to develop, right? Everybody wants to feel like a winner. So if the entrepreneur and the investor set off on the wrong foot, it's not a great thing. We look for ways that we're going to return. Are there complicated waterfalls within the equity structure? What is the liquidation preference? What is the valuation that we're getting? Who are the other investors? Where are they coming in and at what levels, right? We look for various different special terms that could be red flags. Those are things that are important. Revere Partners in particular, we use our database to look at comparables. You can also produce comparables as a startup, but we see comparables that are astronomical, right? The goal, as was also previously said here, is the entrepreneur's goal is not to maximize the valuation necessarily. In my opinion, it's to optimize it, right? Because if your valuation is, then there are problems in terms of potential risk of the next round. Right? You really have to justify, to the gear shift analogy that was made. At the next round, you're gonna have to justify what significant difference you made that then justify an even higher valuation, right? And so you got to think, kind of 2 steps down the road. I would say there are some other trends additionally. It's actually interesting, the comment made about, valuations are different geographically. I think that's true, but a little different in the oral health space than what was said. Within the U.S., I'd say East Coast valuations it tends to be tougher to get a higher valuation than on the West Coast. You see a little, some more easier, higher valuations. Again, not necessarily a good thing. There's also a gender gap here in oral health and other sectors that I think we need to work to equalize. Where, and it is the unfortunate truth, male leaders tend to get a higher or better valuation than a female leader. and that needs to change. There needs to be support around that and recognition around it.
Hey, Jeremy.
Yeah.
Jeremy, I'm just going to jump in because we've only got about 5 minutes left, and I just wanted to give everyone a chance. If there's any final comments that you've given about 30 seconds, anybody want to jump in on that, or you can just leave it to me to wrap it up.
Morning.
Good morning.
How's everyone doing?
So Neil, I think you need a couple things to say. I think you were ready to jump in there. So
yeah, I just have two things to say. We are not big fans of safes in my shop because what we find is that leads to serial capital raising, where they don't figure out what they really need, execute, and then get to the next inflection point. Yes, I understand why people do them. Yes, I understand it avoids a little bit of confrontational and those kinds of things. We tend to prefer our management teams, our technical teams to focus on building their product rather than raising relatively small amounts of capital at a time and then going out and doing yet another safe and another safe. It always bothers us when people do those, and we find that our best companies generally don't do that. Yes, we've used safes, and we're doing one right now, when a company comes up a little short before they go out and raise their next round. But we generally find that the best execution we get from our companies is when they say, okay, we've raised our money, we're going to go execute for 18 to 24 months, and then we'll go back to the market. We find that leads to the best execution, and it keeps our management teams sort of honest in that they have to raise the right amount of money, and then they have to really execute to get their next batch of money.
Yep, agreed. All right, well, thank you, folks. I think we're actually out of time, so let me wrap it up here, if that's okay. What does it take to be an entrepreneur? How do you capitalize on your ideas and turn them into a commercially viable entity? For the entrepreneur, I think you've heard it from the panel, capital is always available in some form or fashion if you meet the basic criteria of an intuitive idea that solves a real problem, a large addressable market, and a team to get you there. Companies with strong values, who aren't afraid to ask for help, and who can quickly adapt to changing conditions are the ones that succeed. It takes a targeted approach to get potential investors' attention, to get them excited quickly, and then get prepared for due diligence. The panel has added some really amazing and great points for entrepreneurs to consider that I think are actionable. And I think the most important one is that if you want a long-term relationship, do a startup, don't get married. So thank you. Thank you all for your time. I appreciate it. And I'm sure we'll be talking again soon.
I sincerely thank you all as well. And if any of you and I are ever in the same real-time space at the same time, lunch is on me.
Thank you.
Fair enough. Thank you.
Thank you. Thank you, everyone.